Thank you for joining us this Friday, the 6th of March. I'm Sophia Mavridis, and I'm joined today by Bell Financial Group's Chief Investment Officer, Will Riggall. Will, thanks for joining us again this Friday.
Oh, it's great to be back again, Sophia. It's never boring in these markets, so we'll try and skip through it quickly and get to the key items on the agenda this week.
Well, jumping straight into it, reporting season has rounded up. What are some key takeaways from the month of February, and any call-outs that investors should be thinking about?
Yeah, look, with all that's going on in the world, you can be forgiven for quickly forgetting at how positive that reporting season was.
Yeah.
Up 4% over the month. Australia's big stocks really showing the way. What was really interesting is that we did have those continual shifts underneath, but looking back at a broad level, what we had were, I guess what the outcomes were, is that the EPS growth for FY26, we just had the first half year, 26 has been upgraded. We're looking for 10 to 11% EPS growth this year. That's really strengthened over the last 6 months. But what's also positive is that those upgrades or the expectations of growth that are coming from our companies flow through to FY27, so next year as well. Quite often you see these short-term boosts in people being confident about the year ahead. And then I guess as you look at growth is a number on a number. So the FY27 usually at this period would not be upgraded too. But what we're getting is 10 to 11% this year, 6 to 7% next year, and that is above the average of long term. So as we look back, the Aussie share market's in pretty good shape, and these companies are performing.
Well, stock-specific market movements. Now we're going into, markets moving due to geopolitical tension. So big shift there. Broad-based market volatility as a result of, the escalation that we've seen in the Middle East. What are your insights there, and what are the historical market records that tell us about, how markets will be impacted longer term?
Yeah, thanks, Sophie. It's really important to look back and learn through history, because in these times of disruption, you can easily be forgiven for having a greater fear of the unknown. But it's actually outside of the human tragedy and whether or not we believe that this was justified. But what we have here is a US and Israel moving towards, removing the leadership in Iran, and this is very different from what we had a year ago. The 12-day war was about crippling certain infrastructure around the uranium enrichment they had. This is about removing a leadership status that's been in place for 40 years. So I think we shouldn't believe that these things can be resolved quickly. I think this may take a while longer, and that just leads to volatility. And if we're looking at it, there are two key things. It's the period of time that this is going to take, which is important to review, but also how impacted is that infrastructure. And all we're talking about now is that the Straits of Hormuz and whether that oil can get out.
Well, oil and gas prices, they surged amid, the potential supply disruptions. European gas prices are increasing around concerns around energy supply security. So what's the impact on the ASX listed stocks that are exposed in these sectors?
Yeah, look, what we've had is probably a usual response. We can look back, there are, back to 1973, if we look back, there are 10 to 15 of these such events. And there's largely a playbook that goes underway. You have oil and gas stocks, so Woodside Santos performing well. It might seem counterintuitive with the geopolitical risks surging, but you do have gold selling off a bit, and that's because the US dollar rallies, and we also have higher rates at this point of rates. So we've got the US 10-year actually selling off. It's moved back above 4%. So we've got the concern really at this stage is inflation. And as I talked about time, the time that we have this disruption, whether or not this kind of feeds through to economic circumstances. So at the moment, we've got bond yields selling off, so the rate's moving up, which is saying, hey, inflation's our problem. But if we get to a point where we think those higher input cost prices around oil, because it is an input across a significant amount of the world, is it going to slow global growth? This great momentum we've got in the global economy, Is that going to be impacted? And that's something we probably won't know for another month or two. So that's the uncertainty here. And as we have this period, markets hate uncertainty, and we're just going to have this volatility. But it's macro volatility. And look, I guess when we get back to it, what is the history? If we look at the averages across these periods of dislocation and uncertainty and geopolitical events, markets are actually up in 1 month, 3 months, 6 months, 12 months, and the ASX responds really well. And if I could just have one more piece, it's that our economy and our ASX is exposed to almost the positive impact of inflation environment. We've got a lot of resources. Usually that environment, those with BHP and Rio Tinto does better. Our banks, got a significant amount of banks, as long as the economic remains relatively stable, higher inflation does lead to higher interest rates. Not great for consumer, but also does help those banks support those margins. So look, all in all, we need to look back. We need to remain calm, keep your cash ready to go, because the opportunities will abound.
Do you think you'll see more investors moving into cash in this time?
There's no doubt that there's this fear. There is, in times of uncertainty, people look to, I guess, go to safe havens, and that's US dollar, that's bond yields and such. So look, we really need to look at history. Yeah, that's just concern, but largely what plays out is that these do end up being buying opportunities, and those that don't raise cash and stay in the market and have great stocks and exposure to good quality companies, they're rewarded for keeping their heads in these times of uncertainty. So so it's really interesting time. We're talking about macro, we're talking about geopolitical, we're dealing with people who are sometimes irrational, but that's the fascinating thing about markets. It's we're always learning.
Well, perhaps just one more question to end. What do you see with travel demand, airlines and logistics companies in these times?
Yeah, they're the first ones to be impacted. We've seen global airlines sold off. That's from the amount of travel that's happening, but also oil is almost their highest cost. So that uncertainty will mean that part of the economy will slow down. But the big sell-offs have largely been concentrated in that area from an economic perspective, but there are a lot of other areas of the economy that will benefit in the short term and the long term. Look, the sad, I guess, result of war and such is that things need to be rebuilt, and so there'll be, in times, there is greater demand for some of the commodities that we dig out of the ground, and that's the harsh reality of these periods in time. It's not the first time we've seen this, but yeah, travel demand will certainly be sold off. But there's a playbook for this type of scenario, and hopefully we can educate, talk to our advisors, and continue to communicate to our clients and help them through this period of uncertainty.
Definitely, we'll be keeping watch and keeping our clients updated. Will, thank you for joining us, and thank you all for watching this Friday.
Cheers. Great to see you again, Sophia.